And a lot of people don't like that, which I don't blame them. It's kind of nice to have. Hey, John Stevenson here, the Guaranteed Retirement Guy, and let's talk about annuities and inflation. So annuities and inflation, a lot of times when people are getting annuities, they're worried about it because, most of the time an annuity payment is set, okay? It's level. It usually does not go up. And so usually when you're thinking, all right, well, I need $70,000 a year in guaranteed income, but I know in 20 years that $70,000, of course, is not going to be worth the same as it is right now. That could pose a problem. Maybe you have Social Security. Obviously, Social Security will give you increasing payments over time, which is great. And you might have a pension also that does that. But of course, there are a lot of pensions that won't do that. So the question remains, how do you beat inflation, or how do you keep pace with it? How do you use an annuity to do that? Well, there's annuities out there that will actually give you increases, but it just depends on the company and how much increase that they will do. I've seen Allianz do increases. I've seen F&G will do increases. In fact, F&G will give you an increase regardless of what the index earns. But Allianz typically will give you a much higher increase, but it is based off of the index growth. So, and we're talking fixed index annuities. And so when you got a fixed index annuity, it's tied to an index. And if the index rises and you're having a lot of growth, then you're going to have your guaranteed income payments go up if you chose the increasing option. The problem with those is a lot of times the actual income that you start with in the beginning is a lot lower. For instance, you might have an annuity that gives you $30,000 a year in income, guaranteed income, and it's level, set for life, which is great. It gives you peace of mind knowing that that's never going to go down, but at the same time, it's not going to go up. Now, if you want to do an increasing annuity payout, usually you're taking quite a hit in the beginning. I would say if you're going to take $30,000 a year in level payments, then you're probably, with an increase in annuity, will probably start around maybe $22,000 per year, I would say on average. A lot of my clients that I talk to about that and I show that, they're like, oh, I don't know. It's going to take me like 10 years just to get up to that 30,000 range. And you start doing the math in your head. I'm like, oh, it's like $100,000 before I actually get to, that's $100,000 that I'm missing out on. I'd rather just have more money right now. And I agree most of the time. There are definitely some annuities out there with Allianz that I think have some decent growth. But again, it's all hypothetical. Okay, you're starting at a lower guaranteed amount, and it's hypothetically going to raise over time with the growth of that index. But you don't know how long it's going to last. You don't know how, you might have a few bad years where it doesn't increase at all. So that's just what you have to think about when you're looking at inflation-adjusted annuities or increasing annuities. A scenario that I usually will plug in for people that have substantial assets and they want to purchase several annuities is a laddering strategy. And really all you're doing is you're buying several annuities all at once, and you may turn on the income of one or two of them in the first few years, but then wait to activate income on the others later on as you age. So that is a good strategy for keeping pace and often beating inflation. I would say an example of this would be if, let's say you have $750,000, okay? Maybe you got $1 million, but you want to put $750,000 into an annuity, okay? So instead of putting it all into one annuity, which you could certainly do, and you could get a large payment for the rest of your life, you could break it up in 3 separate annuities. And then you activate the income on the first one, maybe right now, immediately, and then of course, maybe you wait 5 years to activate the income for the other $250,000 annuity, and then you maybe wait another 5 years to activate the third one. The payout, of course, increases over time. So, $250,000 in the beginning, maybe that'll just give you $18,000 a year, let's just say, of guaranteed income. But let's say the same $250,000, if it's deferred and you activate income in 5 years, let's say, maybe that income is now like $28,000. That's a nice increase. But then you got the third annuity and you wait another 5 years, and let's say the payout is $35,000. So now you know, you got 28,000, you got 35,000, you got 18,000. That's a pretty substantial stream of income coming from 3 separate annuities. Whereas if you put the same 750,000 into one annuity and you turn on the income right now, maybe that income will only be $55,000 or 60,000 or whatever, guaranteed forever. So it's more in the beginning, but over time, it's not as much as the other ones. So, of course, the trade-off is you don't get as much money in the beginning, and a lot of people don't like that, which I don't blame them. It's kind of nice to have more money in the beginning because you never know how long you're going to live. But that is a great way to fight inflation, is to ladder annuities. So you never know what inflation is going to be. You never know what your expenses are going to be. What if your expenses don't rise with inflation, right? What if your expenses are really low? You may not need it as much as other people, but you could still fund several annuities, and then you can just kind of activate the income as you need it. And if you don't need it, just let them grow and leave them to your posterity. I mean, that's always an option too. Anyways, I just kind of want to bring this out because I do get a lot of questions when I meet with people and they're concerned about inflation. That is a way to fight it. I think a very effective way is by purchasing a bunch of annuities all at once and then just activating incomes on those annuities over time. And I would say, in other words, you could do that, or you could just buy an annuity now and then maybe physically purchase another annuity in 5 years, and in 10 years, you could just keep purchasing annuities at different points. You could do that. You don't have to buy them all at once. So there's a lot of different things you can do to beat inflation. If you want to look at those increasing income annuities, there is a link below this video, and just schedule a call with me. If you want to chat about your specific situation, if you're worried about it, we can talk about that as well and create a plan that will help you fight that and be able to have the income that you need right now, but also 20, 30 years from now, still have enough income to meet your needs. So again, if this video helps and you want to chat, go ahead and go to the link below and book a call, and look forward to chatting with you then. Hey, I really appreciate you watching the video today. If any of it makes sense to you, or if you found value, or if you even got a question about anything, I hope that you'll go to the comments section and ask it. There's no stupid question, and I'm looking forward to hearing from you.